We are seeing investors across West Hyderabad execute a very specific, aggressive maneuver, taking a 4 crore rupee budget out of the residential market and dropping it straight into commercial real estate. Look at residential assets in areas like Kondapur. An apartment that cost 1 crore a few years ago might be worth 2 crore today, but the rental income is clearing 53,000 a month. That is a 3% yield on your realizable value. West Hyderabad's commercial sector offers a different calculation. Entry-level yields for corporate space sit between 6 and 8%, doubling the cash flow efficiency of that same capital. But that yield is exposed to a unique macro risk, Hyderabad's Uncapped Floor Space Index, or FSI policy. Because developers can build vertically without strict density caps, the city can pack 250 units onto a single acre. This creates a high risk of mid-tier commercial oversupply in the near future. To insulate your money against that dilution, your capital must be anchored exclusively in Grade A assets within master-planned tech corridors like Narsingi and Kokopets Neapolis, where corporate demand is most stable. Even inside those premium zones, deploying 4 crore into a standard 2,600 square foot Grade A unit forces a choice between 2 distinct investment paths. We can evaluate this through 2 strategies. Srinivas prioritizes under-construction property for tax optimization. Kalyan focuses on ready-to-move-in assets to secure instant rental yield. Your decision in West Hyderabad centers on a trade-off between the timeline of your capital and the long-term efficiency of your taxes. Phase 1 of this process begins with the upfront acquisition costs. Srinivas is looking at under-construction math. He targets a base cost between 10,750 and 12,500 rupees per square foot, plus a 7.5% state stamp duty. This table shows the friction. Because the building is unfinished, the government applies a 12% GST on the purchase. That creates an upfront tax bleed of up to 39 lakh rupees, pushing the total acquisition cost to nearly 3.88 crore. Kalyan's counter strategy involves negotiating directly for a ready-to-move bare shell asset, targeting a flat 4 crore rupee price tag. Since the building is already operational, Kalyan bypasses that 12% under construction GST penalty. Srinivas views that 12% upfront payment as a credit. It gets registered as an input tax credit, or ITC. This ITC acts as a voucher. Srinivas can use it to offset his future rental tax liabilities, creating long-term operational efficiency. Kalyan protects his cash today, while Srinivas sacrifices liquidity to secure years of future tax neutrality. This leads us to Phase 2, the holding period before a corporate tenant occupies the space. During this window, Srinivas accesses a cash flow advantage through developer subvention schemes. In exchange for deploying his cash during the build phase, Srinivas earns a 6 to 7% assured annual yield directly from the builder. This translates to approximately 1.62 lakh rupees hitting his account every month while he waits for completion. The cost of that income is the execution risk. Srinivas absorbs the impact of any supply chain or regulatory delays that push the handover beyond the 2027 or 2030 deadlines. Kalyan faces a different reality. His ready-to-move asset generates 0 subvention yield. However, he eliminates delivery risk entirely. The building is already operational, meaning he can begin the search for a corporate tenant immediately. Under-construction investors are paid to underwrite the builder's construction risk. Ready-to-move investors pay a premium to ensure their timeline is certain. We move now to Phase 3, operational leasing of the 2,600 square foot unit. Market averages for bare shell Grade A space run from 55 rupees per square foot in Narsingi to 85 rupees in premium Kokopet. This generates between 1.43 and 1.69 lakh rupees in raw base rent every month. Calculated against the base cost, this establishes a yield between 5.28 and 7.25%. This waterfall chart shows how the taxes flow once a lease is active. There is an 18% statutory GST applied on top of the commercial lease. The tenant pays this 18% directly to the landlord. Typically, a landlord remits that full 18% to the government. But Srinivas can now activate his ITC offset from the construction phase to keep that rental income tax neutral. Finally, there is Common Area Maintenance, or CAM. This is billed at 6 rupees per square foot. totaling 15,600 rupees a month, plus its own 18% GST. During an active lease, the tenant pays this directly to the building's maintenance agency. The risk occurs during vacancy. The moment the property sits empty, that $15,000 CAM bill becomes a direct monthly cash bleed. Every investor eventually finds that there is no single property that solves for every financial need. Success in West Hyderabad depends on matching your capital's timeline to the life cycle of the building. This matrix helps define the correct path. We map your risk tolerance against your need for immediate cash flow. The Srinivas play is built for high-liquidity investors seeking a tax-neutral structure. It requires the financial patience to hold through a 3 to 4 year construction cycle, while the developer completes the asset. The Kalyan play is designed for safety-conscious investors transitioning out of residential real estate. This strategy prioritizes immediate cash flow and refuses the execution risks associated with unfinished buildings. In an uncapped FSI market, Grade A quality is your only real defense. Choose your timeline, optimize your taxes, and anchor your wealth.